The three most important phrases in the market if you want to be a profitable trader. Number one is understanding the law of cause and effect. In other words, the elastic band effect. Number two is understanding the domino effect in the market and what that means. And number three, and one of my favorites, is if you cannot see the liquidity, you are the liquidity. Now, from just fancy quotes aside, it's important to understand the wisdom behind it, where you'll start to see how an A+ setup, which is what we covered last video, that is showing a major inducement of those typical higher time frame daily supply and demand zones, how they become traps, how they get induced, and how they can lead to wonderful A+ opportunities, which personally landed me $30,000 in profit. And by the end of this video, you'll learn how to read the market from an inducement perspective, not just market structure, not just supply and demand, not just smart money, but actually reading the smart money traps, the trend line traps, the support and resistance traps. This is not just theory. This is me going through the market with today's price action, as I always do, and backing it by my track record, so you know that this is information you can trust, because this exact information takes people just like you who are watching my videos, who are frustrated and failing traders, and help them become vastly profitable traders, successfully achieving large funding and large consistent payouts. So go ahead and check the last video where I did a full breakdown from the daily time frame, top-down analysis, making all of the context there. And it's going to be very important for you to understand also yesterday's trade, which was a wonderful 1 to 10. I close volume at 1 to 10. I have a fixed profit system which is optimized for data, but in certain scenarios you can hold them on, and it would have been a 1 to 20 by the end of today. Not my way of trading. I don't think it's worth to trade like that. Let's say I hadn't taken a partial at 1 to 10, I would be 10% up, and if it went back to break even, I would actually lose 10% of unrealized profit. So when I hold a trade, I'm always thinking, what is the cost of it going back to break even? What is my opportunity cost of unrealized gains? And I think therefore holding high risk reward positions is diminishing returns, because you risk more and more of the capital that you haven't closed to actually gain a little bit more. Think about it like this. Is it worth me risking this 1 to 10, let's say 10%? Is it worth me risking that to make another 10%, to make 20% in total? You could say, yes, you can gain 20%, it's worth it. But I also see it as a 1-to-1 risk reward to hold the trade, because I'm risking 10% that could also go back to break even. But for those of you that have watched that video, you will have full context of what happened yesterday and how we will navigate today. But just a summary for you is, over here we had a major inducement. Why is it a major inducement? Not only because we took a previous inducement zone out, we trapped in sellers in these doji candles, but we actually took out a daily supply level. Daily supply level induced, therefore stop loss is taken. And then a lot of people that saw the breakout looking to buy, and therefore their liquidity in this zone on this 1 touch, 2 touch, 3 touch support level, all of those orders getting induced too, plus some smart money traps we saw in here. This was all wonderful price action to show this is all a heavy manipulation event. And this brings in the two laws that I mentioned in the markets. Number one is the law of cause and effect, or the elastic band. When you pull back an elastic band by taking all of this liquidity, taking all of the daily supply zone, you have stretched that elastic band extremely far, because it's a daily supply level. When you take that out, when you let that go, and that's exactly what we saw. We saw price action very aggressively come to the downside, taking out all of this bullish order flow. I'll cover that in a moment. The second law that we see is the law of the domino effect. We saw the first domino, the major inducement. This is not only the inducement of the day, this can probably be the inducement of the week, because what do we see after the main inducement? The next domino, the next domino, the next domino. And we see that. Domino number 2, inducement. Domino number 3, inducement. Domino number 4, inducement. 5, inducement. 6, inducement. That was all on the same day. And then today we had some more, which I'll cover. The people that saw this as a support level. The people that saw the smart money zone over here. The people that saw this smart money zone over here trapped. The people that were loading up on buys in this demand area. Because why? It had a build up. It had a run of liquidity, smart money sweep. It had a bullish breakout. Buyers are entering over here. They got induced, and then they got induced again. So we can see that if you cannot see the liquidity, you will get induced left, right, and center. And what does this trend line liquidity become? It becomes a zone where people thought there's an entry, bullish candle given, and then slowly induced out. We can see markets giving traps left, right, and center. Hence my 3 sayings: the law of cause and effect, the elastic band theory, the domino effect that we see in the market, and if you cannot see the liquidity, you are the liquidity. These things are often apparent, especially on an A+ scenario like these days are. So let's actually come into replay mode and go back to how the day was unfolding before the trade had actually played. The first thing I can see is, if we have this inducement in control, and they show me that they are maintaining control based on all these inducements and mitigations. If the sellers are in control, where are they going to target? They're going to first target a demand area. So we sell until we come all the way to demand. And then in this demand area, there is an argument you might continue higher, because it's bullish impulse, bearish complex pullback, retracements, and then bullish continuation. So there is that argument there. That's the first initial target. But after that target, I can also see, forget this target that we had from yesterday. We also have this trend line liquidity target. And if we zoom out and remind ourselves where we are on a higher time frame, we originated this move from this demand area over here. This is the main demand area. We go on a 4-hour time frame, you'll see a better build up inducement demand that took us all the way to this supply. So price can come all the way back down to close these imbalances and actually come to this demand area. So there's a lot of potential, let alone the daily time frame where this is a reach, and I don't think this will necessarily happen, but we have market structure showing us we could make a new lower low. So not just this demand area, not just local demand, not just interim demand, but actually daily making a lower low. So there's a lot of potential of bearish movement. I don't get caught up in that because I'm not a swing trader. I don't necessarily use fundamentals, so it's not my way of trading. But let's actually read what's truly going on. As we know from this demand area, not only was it structurally relevant that made the higher high, but it's also a buildup of liquidity, inducement, mitigating into previous inducement zone because of that minor inducement, sweep of Asia low. This one is also having a mitigation in London open, so showing us the significance of this zone. But we can see as price comes in, we tap in, we invite in early buyers, then we induce those buyers out before we've grabbed liquidity from this zone, becoming a smart money trap, and then giving the reaction. So we've swept Asia low, we've swept this smart money trap, but we can see that the buyers don't take control. The buyers don't hold price action. If I'm to observe even over here, we can see that price came into this demand area, gave a bit of a reaction, and then took them out too. So why is that narrative switching? Well, it's very simple that when you go back to the major inducements, you go back to the top where the journey begins, and we see sellers are taking control from this major inducement, mitigation, inducement, mitigation, inducement, mitigation, inducement, mitigation, mitigation with an inducement and smart money trap. We'll continue on. Who's in control? Inducement, mitigation, 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 and it goes on and on. Order flow, liquidity. What happens? Inducement. So we can start to see really that the sellers are in control and the buyers are not. The buyers are not showing any intent. For example, when they do shoot lower and maybe grabbing liquidity, they push up, meet supply, push lower, try and grab a bit more liquidity. What do? Meet supply, and then overall ending up failing. So we can see there's no buyer strength. There is seller's control. That is evident. Not market structure, not supply and demand, not these things. Liquidity cycles, inducements, the domino effect, the laws of cause and effects. These things show us that the daily cycle is Asia high sweep, early sellers pre-New York open, New York open inducement, and then New York key window execution. So now that we've brushed up and summarized what happened yesterday and overall context, make sure you do go watch the video because this is an A+ setup. This is a prime setup you take 10 out of 10 times. High win rates, high risk to reward. Definitely worthwhile putting good risk on this and always taking these trades. These trades are 6.5% in a single day, making 1 to 10 risk reward in a single day. And most importantly, in the space from entry to 1 to 10, it's only a handful of hours, not even a full session. 6 hours to get 1 to 10 risk reward. For me, $30,000. If you're on a funded account, on a $100,000 account, that's $6,000 for you. So these are literally life-changing amounts of money done with ease. There's no heavy retracements. There's no consolidation in the entry like a swing trader would face. It's tap and go, immediate action, immediate feedback, and high probability. You can take these kind of trades a few times a week. Your trade frequency is high. Your rate of return is higher than a swing trader, and your win rate is solid. You don't have the psychology of being in drawdown for a few hours because you have a very protective stop loss that is tight because you understand M1 inducement. This is by far the best way to be trading, and I can say that because I used to be a swing trader for 3 years. But now getting into today's trade, let's do a full daily cycle read. So as a daily cycle usually presents, you have Asia range that has its high and low, and Asia range usually gives you a message to say, hey, trend line, sell, 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 sell. So what happens when the day opens? We trap in early buyers who are catching what? Asia low sweep on Frankfurt open. That's why we have the time window coded in my personal indicator. We trap in buyers early, and then we show these trend line sellers that, hey guys, sell, and then we get those people invested. So when we took out these early buyers, we also invited in sellers who are seeing this trend line, extending the trend line out from yesterday. All of this trend line liquidity was activated further with this rejection. So what does that mean? That means buyers are taken out over here, and then when the sellers are seeing this zone tap, they get taken out also. So buyers are induced, sellers are induced, and this became a London manipulation. Perfect. What is the purpose of that manipulation? To grab as much liquidity, to fuel moves higher, to go where? To not just to go to Asia high liquidity, but to grab and come into these previous zones where this order flow was in control. Price comes in, induces, not only just this local level of Asia high, inviting in more sellers who saw an inducement of Asia high, but actually inducing the overall zone. Once we saw that inducement, this is where you come to M1 and start to understand the markets deeply. And what we can see here is the law of cause and effect. And with that law of cause and effect, the elastic band effect, we see a local buildup, we see an inducement, and then we see market structure shifting. All these levels of market structure, including previous buildup, inducement zone, push out, mitigation, push out, all of these levels getting taken out. So we can see that this is an intenseful move because it takes out all of these structures, comes back for an M5 mitigation, showing sellers are in control, sellers are in control. Thereafter, we see price continues to go lower, print an equal lower level, or even a slight break of structure. I'm going to call it liquidity because I don't really count half a pip as a break of structure. And when I see that liquidity level below, what I start to notice is we have a local buildup over here with some highs. After that, a potential inducement. Therefore, if we've seen a potential inducement, I want to be interested in this supply zone on this refined IFC after I've got confirmation, for example, a structure shift. So what's a typical entry? It's like always the liquidity cycles that we mentioned. Once I get a break of structure, a clear shift, I now have my trinity because I'll have what? Build up, inducement, break of structure, and entry on the mitigation. So I have inducement, I have lower time frame confirmation, and I have time window, this gray box. So I'll have everything that I need and context because I'm trading away from the dominoes. These guys are in control. These guys are in control. These guys might be in control. I need to confirm it. By the way, this is the same formation we continually see. For example, right here in yesterday's price action, build up, inducement, break of structure, mitigation becoming the entry. Same thing that we saw over here. We saw a build up of liquidity, smart money trap. So then we had inducement, break of structure internally, and mitigation in the key time window, London open. So we see these things are repeating patterns, and I can go on and on, by the way. Literally daily, this is happening. What's happening right here, for example, it's not in our window, but we have build up, inducement, break of structure, mitigation. This is a law of the market. This is a language. This is how price moves. And you'll see it time and time again. Build up, inducement, break of structure, mitigation. When you see this repeat again and again, you can be very confident that it's the truth of the market and start to use it to your advantage in the trinity of time window, lower time frame confirmation, and inducement. When you connect these things together with the context of a trade, becomes a perfect execution. So what I usually do in my trading session, I trade GU and EU. And when I have both side by side, my objective is to see how both are behaving and interacting with each other. Is there any correlations? Is there any divergences? Is there anything to read from one to the other? And for now, we can see price action is pretty much mirroring, is doing the same things. Where price is coming to this supply zone, which is a supply zone over here. We've made a lower low over here, which is a lower low down here. So we can see a lot of things are aligning. But I'm looking for an entry now, so I need to read the picture. And as I play price action forward, I start to notice something very nice over here, which is the market has shot up higher over here. We have broken the previous level. We have broken the previous inducement supply zone, and we've actually depegged and had a shoot higher high. We've got this divergence in play where the market is forming a high and then we're forming a higher high. That depegging in the market that we see, we call it divergence. That divergence we can see in the market is not happening on the correlated pair. In this case, on EU on the same time, at the exact same minute, at 2:13, all the way down to the inducement at 2:53. That is going in the opposite direction. We're getting a divergence because whilst one is inducing over here and then forming a higher high, this one is inducing over here and forming a lower high. So why is one going lower and the other going higher? This is a sign of divergence. We've got a bit of a target here to attack now, and we have all these downside targets, for example, coming back at least to this demand area of the London session. So we have targets despite everything we spoke on the higher time frame and the domino effect and so forth. The context is absolutely there. But the lower time frame execution is now revealing itself as we get this divergence. I play a few more candles and I see perfect. That could be an entry right there. Before the break of structure, we could get a potential entry right here based on the divergence, because now we've got confirmation with the mitigation and you have a 4-pip stop loss. That wasn't the entry I took. The entry I would take is when we have the break of structure to confirm it. We've now got divergence plus inducement plus break of structure in the key time window with context of the whole trade setup. Now this becomes a better opportunity, and I put my entry right here based on lower time frame modeling. If you don't know, join us inside our community. We live stream twice a day. You can have a weekly one-on-one. We have Q&As. We have so much resources. I don't need to explain. It's the best offer on the market. We truly change lives. We've created so many traders who have become full-time, traders who have left their jobs. We're really doing out here, and we're transparent. We have so much going on inside this community, and it's so affordable. You'd be blown away. Find that link in the description. But anyhow, this is exactly how the entry would be in this case. We wait for the market to tap in, do its thing. We notice it closes off the exact M1 imbalance. I don't trade the M1 imbalance specifically when it's such a sharp stop loss. Although we could have, it's a 4-pip stop loss. I didn't. I left it down here. But even let's say I did a 4-pip stop loss, the risk reward would be even better than what it was actually achieving. But we can see that the correlation was there. Everything executed perfectly. And then the break even on an M1 shift as always. So we can see that even with an inflated stop loss, our break even is very close and our 1 to 3 is very close. Let's not even mention if our stop loss was up here, our 1 to 3 would just be here. So when you trade this way, to lock in your first 1 to 3 partial, locking in 1.5% is so achievable because you're trading small, sharp reactions. You're trading the markets when it's most likely to reverse, when there's volatility and there's an inducement to confirm liquidity. You're trading sharp reaction points and aligning with context to hopefully get further. But if you know the average session volatility of a New York session or a London session, it's 15, 20, 25 pips, and your average take profit is 15 pips. Within a session volatility, you can find your 1 to 3 risk reward within the space of 5 to 15 minutes. This is something that I've done hundreds of times in my life, in my public signals, in the live streams. I've done this so many times. Trust me, this is the best way to trade. trade because you can pay for your next loss. You can get immediate feedback, and as long as it's not hitting stop loss, the chance is it will hit your TP1, and that's a power in the market. It gives you such a confidence boost, and it helps your P&L because in certain weeks the market has reversed on me and I've gone break even every trade, but at the end of the week I would have got 4 or 5 1-3s, these partials which add up to a few percent at the end of the week when I was wrong every time. This is how you really extract profit from the market, even when you're not always correct. Now that I've entered the trade, I have broken even my position, saved by a whisker over here. In these cases, when it's coming back to a clear refined IFC, you can also do a reduced risk offer, which is something I always do when it makes sense. But either way, you manage that position accordingly. The reason not to worry is because price action on EU is keep going lower, so there's not really signs to worry. 1-3 risk reward hits, you take a partial. At 1-3, you lock in 50% volume, that becomes 1.5%, and then you let the rest of the day play out. And we monitor and we see, okay, we did a potential inducement low, we had a shift higher and gave a small reaction and failed. There is no buyer's control over here. Same thing happening here. We're getting a build-up, inducement, mitigation, price goes higher, and then sellers regain control. And this is where we are currently. We are seeing that the sellers are right now in control. We have maybe had a small inducement and a push out, but the end of the day has arrived, and I will leave this to run for the rest of the day to see if it meets my 1-10 target. But if I had had the smaller stop loss, which I didn't take, we'll be running 1-20 and my 1-10 would have been long gone. So this was a slightly larger stop loss than my normal, but again, a wonderful trade. And when we connect it 2 days in a row, A+ setups, a wonderful setup over here. This was flawless, textbook. This one could have been a little bit better, but once again, still a great trade. So in the space of 2 days, when you know when to time the market, 2 potential 1-10 trades, and just imagine what that could do for you on a funded account. This is the best way to be trading, but don't get caught up in M1. Don't just take these inducements and try and trade them all, because as you know, a restricted trader is a profitable trader.